Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, April 22, 2015. Inside the numbers, we'll discuss the SPY and the E-mini contract. I've got a lot to say on that tonight. We'll talk about crude oil, gold. I've got a lot to say on that. Interest rates in the bond market, we have some stuff to talk about there. And the U.S. dollar, likewise. All right, let's get into the charts over here. So this is the SPY, and this is the hourly chart, right? So today we had, we woke up this morning and the market was down. It was down overnight and the market was down. And here we are early in the morning, right in this area here. This is 10:30 in the morning. So between 9:30 at the open and 10:30 in the morning, the market goes down. In fact, you can see a better picture of it from the 10-minute chart, okay? Here's where the market opened, right here, okay? And then we go down, and at 10:20, we make a low and a reversal. Now, just as a little bit of a trade school item, so when you're in a trend, and this is a short-term trend, so this is a short-term downtrend, right, this morning, okay? And the market seems to put in some kind of a low, but finishes on the high of the candle or closer to the high with one of these narrow square type of candles. Now, it's not a doji, but it's something better than a doji. Not better, it's something bigger than a doji, but it's really a square candle. So it's somewhere in between a square and a doji. Not to say this is a bottoming tail by any means, but it can be a bottoming signal, okay? Now, when you see this on a 10-minute chart, your first indication is, well, maybe there's higher prices. So let's wait a few minutes. Let's see what the next candle does. And what you do, if you're an intraday trader, you wait. And if the if any 10-minute candle closes above the high of this candle, the previous down candle, big down candle, which was 209.76, okay, then that would be bullish. So when this candle started going up and closed above that, that was bullish, and that was up for the rest of the day. Now, here's another signal. If you're looking at an hourly chart, okay, an hourly chart, you're over here this morning, okay? Now, here's your low, and your next hour was basically a reversal of the prior hour. That's another bullish tone. So by 10:30 in the morning, okay, here we are. 11:30 in the morning, okay, when we finished the second hour, so from 9:30 to 10:30 was this hour here, okay, right in here, and then 10:30 to 11:30 is this hour here. Once 11:30 hit and this put in a reversal candle, that was bullish. And that intraday action, coupled with the concept of I've been telling you to buy the dips for I don't know how long. This is not a sell the rips market. You've heard me say that before. Right now, it's a buy the dip market. Okay, so each and every dip we're going to buy for higher prices. Now, I'm not going to belabor this because you all know, if you've watched any of the videos, you know that I've been preaching this and pounding the table night after night after night that we're in the buy the dip part of the year for this market, okay? So I had these lines in here, and that was a protection on the downside, so we knew where we were going. But let's talk about the upside, okay? Because since the momentum is carrying us upward, okay, we know that the 207.50 is still going to be good support on the downside should we go down tomorrow or Friday. Okay, we don't have to worry about that right now. We know where our support is. On the upside, okay, I'm going to talk about the E-mini because my calculations, as you know, are done in the E-mini. So here's the E-mini contract, and basically tonight we closed right around 2100, okay? 2104, really 2105. We need to close above 2105 in order to achieve higher levels. Now, I've told you that a couple of times, okay? And, you know, from an intraday trader perspective, yeah, you can certainly trade the market intraday, and I showed you what the things that I'm looking for in terms of reversals and intraday trades. But from a bigger picture, if we're looking for higher prices, don't really care what day it comes in on. We're not playing options, or we're not, anything time sensitive. We're just taking a stance that the market's going higher. So we're either in some stocks, or B, we're actually in a SPY, Spider, or an E-mini trade looking for higher prices over multiple days. Well, if we're in the higher price over multiple days camp, we're in the buy the dip camp, and we're looking for the market to confirm above 21, in the range is 2103 to 2105. Once we close above that area, then we go to 2115 to 2120, and we keep going from there. There's higher numbers. There's a 2130, 35 that I told you about 3-4 months ago. Now that's on the horizon. So we could certainly get a breakout at any point in time here. The market remains bullish. Now think about all the bearish news. The media was bearish for the last several days. You folks are bearish for the last several days. I'm getting emails about bearish behavior. I can tell I'm getting emails about people buying puts. I'm getting emails about short levels in the SPY. I'm getting emails about shorting stuff, all this kind of stuff. And the media is bearish. So when everybody's bearish, that's actually a very, very good indicator that the contrary thing is more likely to happen. It's not a sophisticated technical indicator. It's more of a common sense indicator that works way more than most of the time. Okay. So, we're looking for higher prices here, and I'm looking simply for a close. And when I say close, you don't have to wait till the end of the day. First, it begins hourly. And the market, if it remains strong and firm hourly above 2103, 04, 05, and we start to go 2106, 07, then you can start to look for 2115, 2120. And then, from there, you're not going to see a straight shot to 2130, 35. The market's going to react off these levels, off the 2115 to 2120. You'll pull back to 2105, 07, 08, and then it'll go up again. And that's the way the market works. It works in ebbs and flows. It goes up. Let's say it goes up 10 points, pulls back 3 to 5, maybe 7, goes up another 10 points, pulls back 3, 5, 7 points. That's the way the market works. Look what's going on here. We go up, we pull back. We go up, we pull back. We chop around, we go up, we pull back. We go up, chop around. Now we're going up again. Maybe, hopefully. That's the way I'm reading it. Okay, the market goes in ebbs and flows. Even if you look at, let's just bring up a random chart. Here's Intel, okay? The market goes up, pulls back, goes up, pulls back, goes up, fails, lower high, pulls back, another lower high, pulls back again, okay? Goes up, pulls back again. Now we're going up. We'll see what happens. You see, it's just we go in, it's that ABC pattern. It's the up, A, B, down, C, up. Or it goes in the reverse. Down is A, up is B, down is C. Okay, here's a B, C. Here's an attempt at here's an A, B, C. Okay, so the market, they all look the same when you know what you're looking for. If you zoom out, okay, to a bigger picture, a bigger time frame, you can see the ebbs and the flows of the market. So the same thing applies. Let's go back to the spider chart. The same thing applies on an intraday basis. This is the reason why a lot of folks get whipped out of the market, is because it'll go up, they hop on, it'll pull back, they get scared out. Goes up again, they think they missed it, they hop on, pulls back, they get scared out. Happens all day long, every day. Remember when I've told you a number of times, I've written and I've told you a number of times that the spider, S&P, and markets in general are tricky. Okay, they're trying to get you to think they're doing the other thing before they do the thing they're supposed to do. I know that sounds quirky, but check this out. Okay, and then we're going to move on. But let's look at the 10-minute chart here. And what happened? This is today at 10:20 in the morning. So we start out at 9:30. We go straight down. What does it look like? Everybody's bearish. The media is bearish. What's going on? The global market's this. Who knows? Okay, Petrobras, all the nonsense is coming out of the woodworks. Okay, earnings are weaker than expected. Let me tell you something. Earnings are always weaker than expected. Who cares what's expected? The companies earn what they earn. I'm not going to get on that soapbox tonight. But here's the point. The point is that the market was doing the thing that it wanted everybody to think it was doing to scare out the weak hands. How many people you thought bought down here today? Okay, other than me. How many people bought down here today? Okay, and then it rips higher and goes higher all day. Now, at 10 o'clock in the morning, who thought we were going to make new highs today? Okay, who thought we were going to rip higher and finish close to the highs today? Not many people. Okay, that's the point. It always tries to trick you, specifically the S&P. When you buy the S&P, whether it's the Spider, whether it's options, whether it's the E-mini contract, you buy it, and it's like somebody out there knows you just bought it and sends it down 2-3 points immediately on a dime, right? It happens time and time again. And then you start thinking, oh no, I was wrong. I made a bad trade. And then you start thinking about selling it. And sometimes you do, and you say, all right, listen, sometimes my first loss is my best loss, and that could be true. And you sell it, and as soon as you hit the sell button, the next tick is higher, and it never looks back. You just sold at the low of the day. It happens all day, every day in the S&P. Okay, that's what the S&P was made out of. All right, let's move on and go to gold. Gold is just not good, okay? We broke 1200, we broke 1191. That was 2 lines in the sand I gave you. Now the next line in the sand is 1180, 1181, and we're at 1186, and it just doesn't look good. I don't like it. I stopped out under 1200 today, and I'm going to reassess, and I'm going to wait for something to develop, a pattern to develop. I'm going to wait for the market to give me an indication of what it's going to do based on the probabilities that I look at. So I'm not interested in playing a market that's playing games with me. So I stopped out, small profit. It's fine with me. There's another trade around the corner tomorrow, and on Friday, and on Monday, and any market you want, there's a trade around the corner. When a market's not behaving and it leaves you scratching your head, there's no reason to be in it. Okay, we don't have to be in it for pride. Okay, we have to be in it to make money. And if we think that the probabilities that we went into the trade have changed out of our favor, then why would you stay in that trade? Okay, if the reason you bought the stock or the bond or the commodity or whatever it is, or the reason you entered the trade changed out of your favor, then why would you remain in that position? So that's what I feel with gold. Now tomorrow, it's probably going to rip higher because I sold it today. I get it. It tricks everybody. I'm not excluded. Not just the S&P. It's gold, it's oil, it's everything, okay? I get it. But I'm not willing to play in a market with my capital when it's not doing what I thought it was going to do. Okay, so the probabilities in my mind have changed. So I move out. And that's the way you treat this as a business. It's a profession, okay? It's my capital is my inventory, and if I don't have any inventory, I can't make any money. It's that simple. So I keep my capital in my pocket on gold. All right. By the way, for you home gamers out there, if you're long gold, your line in the sand is now 1180, 1181. If you close below that hourly and then daily, then the foregone conclusion is 1170, 1175, which really isn't that far away altogether. But all in all, it just doesn't interest me at this point. If you want to take a look at GDX real quick before we move on to oil, GDX was obviously down in sympathy of gold, down about a 3% today. 3% today, which is a big hit. But that's what happens with the gold miners when the price of their inventory comes down and they can't control it, and they can only sell their inventory at a lower price, lower than they could yesterday. It affects the stock price, and GDX is weak. Came into the 20-period moving average, and if you don't hold that, you're probably going to come down here somewhere in this 1850 to 60 area, and you've got to hold that 20-period moving average right here. It's the green, the red line, and tomorrow will be very important for GDX, and it'll be very important for gold for that matter too. Let's move on to oil. And oil's interesting because it's struggling below the top of the trend line, or the top of what was the channel. So this trend line has basically been formidable resistance for oil, and until we can recapture this trend line and get above this trend line, there won't be higher prices. But what I can tell you is, as long as we stay above this green candle here, which has a low of 54.88, all right, then you're still in a somewhat bullish position, okay? Because if I took this away, all right, let's just say I took this away. This looks like an uptrend, right? It only looks to the naked eye like it's not an uptrend when I have a line going across that here where your mind is telling you that this is resistance because I've told you it's resistance and you see the market hitting resistance. So, you know, that it brings up an interesting point. It depends on what you look at and who you listen to out there. I can make a chart look any way I want for the most part. Well, I can't make a bullish chart look bearish, but I can manipulate charts. And when I say me, I mean any analyst out there can manipulate charts. So when you read blogs out there and you get other people's work and they tell you certain things doing a certain thing because of whatever, and they show you a chart and it looks different than something I've showed you or somebody else, somebody's wrong. And it could be me and it could be somebody else. But the point is that we can all make charts look a little bit better to fit our story. They don't all look the same. So I just showed you a good example where I could show you a different trend line. In fact, what if I did this? What if I took oil and I drew a different line in there? And I'm not doing this for the first time. I mean, I do this, right? If I had a trend line in here, okay, showing an upsloping trend line, all right, it's not exact, but you get the point. So I would say that if we came back down into this area, that would also potentially be a buy zone, okay? And if I just had this line in here without the top trend line, we would say that this market's in a bullish position. So when I have this other trend line in here, I'm going to remove this. I'm going to put this back. Wrong one. I'm going to put this back, and I'm going to explain why I keep this in there. You know, over the last several days, the market has been somewhat bullish, right? It has been bullish for actually a few weeks. But I knew that this was going to be resistance because we came into a prior high that was an important high, and then we basically sold off from it. So now we come back into that high. The market is retesting that high. It doesn't just go right through it. It's got to think about it for a while. So what we're doing is we're moving sideways, down, and all around that high. And the market's either going to be repelled from that high, and it'll be formidable resistance, or we're going to break through that high and make new higher prices, 58.60, like I've been telling you. So that's, it all depends on how you look at it. But this is an upsloping trend line here that could be considered a bullish trend line on the upside. Okay, so don't think that this is bearish behavior. Actually, the way we're moving sideways is more bullish than bearish, but this is still resistance until it's not, until we get through it. And that's why I wanted to explain that. Okay, so that gives you an idea where we are in crude oil. Bond market. Oh, this was a good one. So we were moving sideways. This is TLT. And, excuse me, and so I told you that we were going to break one way or the other, but I didn't know which way. And I did say that if the market was going to go higher, you would typically have lower bond prices because money comes out of the bond market into the stock market or out of the stock market into the bond market, which would mean higher bond prices up in this area. And we got, that story played out. So we got the lower bond prices, higher stock prices today. And if we continue with higher stock prices, I would think this trend would continue. And at this point, and the way I do this is I don't guess that we're going to continue down in the bond market tomorrow. What I do is I start looking for support areas that will certainly stop the market from falling and usually promote a bounce for anywhere from 2 to 4 or 5 days. And those are the type of situations where we can make a quick gain in a tradable bounce in the TLT. Now, where those levels are, I'm not sure yet, so I'm going to need one more day to figure those out. I want to see what we do tomorrow. If we go down tomorrow, I certainly have 2 levels in mind. If we stall out and don't do anything, I want to see, how the market develops over the next period of time, day or so, before I decide, what's going to happen. But certainly over the next several days, there's going to be a trade developing on the TLT, one way or the other. That much I'm pretty certain of, so stand by on that. But this played out pretty much the way we anticipated it. Sideways, I said it would break, and if the stock market went up, it broke shrunk lower, and that played out pretty nicely. Only we just didn't have anything definitive telling us it was a really high probability trade to take it. But as long as we talk about it, you start to understand what I'm looking at, and you start to get the picture and look at things maybe a little bit differently than you looked at them before. So hopefully that's helpful. So let's look at the dollar, and then we'll give it a wrap tonight. I know it's long, but I think I'm giving you good information, so I don't mind the extra few minutes if you don't. So the dollar, I said that I'd love to buy the dollar in here. We didn't get back down to this zone, and it was basically a one-day wonder, a 5-minute wonder. But in the short run, I think we're going to have higher prices tomorrow, maybe tomorrow and Friday in the dollar. Beyond that, I'm not exactly sure. We're going to have to recapture this area here, and you can start to see how this works. The market is really nothing more than a set of steps. 92. So in order for us to have any kind of a sustainable rally in the dollar, we're going to have to close hourly and then daily above 98.92, which is the high of this candle here. You start to see how the market works. Then what would the next resistance point be? The high of this candle. Then what would the next resistance point be? The high of this candle, this high here. And then you just go, and then on the downside, it works the same. You just go from one resistance point to the other. And if you don't know how to pick out resistance points, you'll learn over time. You got to keep watching. You got to keep letting me feed you out little bits and pieces, and you start to look at the markets differently than you've ever looked at them before. It's pretty interesting. So I think there's higher prices this week in the short run. Beyond that, I can't see it, so I don't have anything definitive. But what I can tell you is that on the short run, within the next day or so, I'm bringing up a chart on my other screen too, because I have some lines drawn in. These are more like secret lines on my other chart. Okay, so bear with me. Give me a sec. Okay, yeah. So you're looking at the 200 at the upside tomorrow or Friday if we go up that high. So call it 98.50 to 98.75 is your range that I would expect the dollar to be trading in between Thursday and Friday. That's got a high probability. Okay, all right, folks. I think that's it. Hopefully this is helpful. Hopefully it's good information for you. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.